I have some very important and breaking news for you today, December 14th, 2025. The Federal Reserve has officially turned the money printers back on, starting December 12th, 2025. I want to be completely honest and say that I was wrong in my earlier prediction. Back in 2024, I had said that the Federal Reserve would restart money printing in 2026. And as we moved closer to next year, I thought the process would begin in early 2026. But that did not happen. Instead, the Federal Reserve began this process on December 12, 2025. Now, they are not calling this quantitative easing. They are calling it reserve management. Technically, they say it is not QE, but in reality, it is just a rebranding. It sounds nicer, but it is the same thing. Balance sheet expansion, money printing, and liquidity injections under a different name. What is even more shocking is that this is not a small program. The Federal Reserve is starting with $40 billion per month, which is an enormous amount. They are claiming that they will begin with $40 billion per month and then slowly reduce the amount over the coming months. But frankly, I do not believe that at all. History shows that once the Federal Reserve starts printing money, it becomes dependent on it, just like an addiction that requires larger and larger doses over time. They are not fooling anyone who understands how this system works. What makes this situation even more ironic is that Federal Reserve Chair Jerome Powell has once again stated that the Fed remains fully committed to bringing inflation down to 2%, even though inflation has been rising. At the same time, the Federal Reserve has cut interest rates by 0.25% and has restarted money printing at $40 billion per month. So the claim that they are serious about fighting inflation is difficult to take seriously. This is precisely why I have been increasing my exposure to gold and silver. The Federal Reserve concluded its latest meeting today and held a press conference, during which they released their official statement at 2 p.m. Eastern Time. In that statement, they confirmed a 0.25% interest rate cut, bringing the federal funds rate down from 4.00% to 3.75%, and they announced the resumption of asset purchases. The statement also says that future rate decisions will depend on incoming data, as usual. Most importantly, the Fed stated that it will begin purchasing short-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis, with no clear end date provided. In addition, the New York Federal Reserve published details confirming that $40 billion in Treasury bills will be purchased starting December 12, 2025. This particular meeting was significant because the Federal Reserve also released its summary of economic projections. According to these projections, the Fed now expects U.S. GDP growth in 2026 to be 2.3%, up sharply from the 1.8% growth projected earlier. They also expect the unemployment rate to end 2026 around 4.4%, roughly where it is today, suggesting that rate cuts and money printing will prevent further deterioration in the labor market. At the same time, they are projecting lower inflation in 2026 compared to earlier forecasts, which raises serious questions about how inflation is supposed to fall while the economy strengthens through rate cuts and money printing. The Federal Reserve did not clearly explain how this outcome would materialize. Even more questionable is the Fed's projection that there will be only one interest rate cut of 0.25% in all of 2026. Given that Jerome Powell is expected to leave his position within the next several months, and that a new Federal Reserve Chair will be appointed in 2026 with a likely more dovish stance, the idea of only one rate cut next year seems unrealistic. During the press conference, Powell attributed stronger economic growth to higher productivity, possibly driven in part by artificial intelligence, and suggested that higher productivity allows for stronger growth without a significant drop in unemployment. When asked why the Federal Reserve is starting with such a large amount of money printing, Powell cited the upcoming April 15th tax payments, explaining that reserves typically fall sharply during tax season and that the Fed wants to ensure ample liquidity in the system. He also noted that ongoing growth in the balance sheet requires monthly increases in reserves. Finally, when questioned about why inflation does not appear to be the top priority, despite high living costs being the biggest concern for Americans, Powell responded that supporting the labor market and ensuring strong wage growth would help people feel better about affordability, even as the Fed works toward its 2% inflation goal. In summary, as of today, December 14, 2025, the Federal Reserve has cut interest rates, restarted money printing, released optimistic economic projections, and signaled a continued willingness to expand its balance sheet.